Again, thank you for joining. We've got a great group of speakers here. You're going to hear from Tom Sanzillo, the director of IEEFA and the former first deputy state controller for New York. We've got Lisa Ann Hamilton, the director of the Climate and Energy Program at the Center for International Environmental Law. Susanna Vickers is joining us, the executive director for pensions at the Office of New York City Comptroller Scott Stringer. And Henry Garrido, the Executive Director of the American Federation of State, County, and Municipal Employees, District 37. So we're going to walk through a bit of an agenda here. We have some slides, and then we have a few resources to put up on the screen, and then we'll take question and answers. So what we're doing here today is really, we want it to be a resource for cities that are considering divesting from fossil fuels. We know this is a complex issue, whether this is something that's being seriously considered in your jurisdiction, or if it's something you're just beginning to consider and want to learn more about, we certainly want to be here as a resource for you. Again, on behalf of Mayor Bill de Blasio, New York City Comptroller Scott Stringer, our sponsors, C40 Cities, the Mayor's Innovation Project, and ICLEI USA, as well as elected officials to protect New York. Thank you for joining us this afternoon. So let me just launch in and click ahead to that slide. For New York City, divestment has been something that is important to us, and yet not the only thing. When we announced in January that we were going to be divesting our pension funds from fossil fuel reserve owners, one of the first questions, of course, we got is, well, how do you think that's going to solve climate change alone? And we're going to talk a little bit about divestment alone, but I wanted to put it in context for what we're doing on climate and how it fits into that. And so in the wake of Hurricane Sandy, climate change became quite real for us here in New York City, and we accelerated our efforts both on the mitigation front to deal with the greenhouse gas emissions that are causing climate change, which we've already reduced 15%. We've aligned ourselves with the Paris Agreement. We're continuing to pursue a deeper cuts to our emission sources in the city. We're also spending $20 billion adapting our city to the risks of climate change, working with all of the local infrastructure providers and communities all across the city to begin the process of adapting New York City. And next slide. This year, what we've done is add to that program with a program of climate accountability. And we filed suit against the 5 largest fossil fuel companies that are most responsible for the damage we've seen here in New York City. And we're doing that to protect New Yorkers and make sure we have the funds necessary to continue to invest in the resiliency measures that we need. And in that same event, we committed to be the first major U.S. city to divest our pension funds from fossil fuels. We ultimately have, across 5 different pension funds, approximately $190 billion in our pension funds, approximately $5 billion of that held in fossil fuel reserve owners. So what Mayor de Blasio, as well as other trustees, committed to on that day was, over the next 5 years, by the end of 2022, we are going to be fully divested from fossil fuel reserve owners. We were the first city or state really to make a commitment like that, and also the first to take action to sue as well as divest from fossil fuels, and put it into context of our efforts to mitigate and continue to pursue sustainability, to adapt our city, and to hold fossil fuels accountable for the damage we've done. We see this as comprehensive climate action that makes sense. Next slide. So why divestment? For us, it's as part of that comprehensive climate action plan, it sends a clear moral and financial signal about the need to move away from fossil fuels. It's a market signal. As you can see in this graph that was published in Bloomberg a few months ago, what we continue to see is that fossil fuels are decoupling from the general market and are underperforming that market. And so for us, there's a baseline assumption that these securities are underperforming. They have poor outlook. The risk of stranded assets is going to continue to drag down the value. And so we're not just pursuing this because it makes sense for climate policy. It also makes financial sense to protect our pensioners and to act in accordance with our fiduciary duty. We're going to hear more about that from the rest of the speakers. I wanted to set a little context before we did that. And again, we're going to hear from a few additional speakers. I'll introduce them as they come online. just want to reiterate before I wrap this beginning part up that keep in mind, if you do have questions you want to ask, please type them into that question box on the right hand of your screen. We'll be able to then notice that and unmute you so you can answer a question during the Q&A period. Again, thanks everyone for joining us. And hopefully, Tom, I'm going to hand it over to you to talk through a little bit deeper about fossil fuel investments, the outlook, and the risk that we see right now.
Right. Okay. Thanks, Dan. So should I start?
Go right ahead.
Okay, thanks. Thank you, everyone, for dialing in this afternoon. My organization is a group of finance and energy experts, and we do work all over the world. And I agree with Dan that there are all kinds of activities that are going on in climate change all over the world, and divestment is one very significant.
Hi, Anna Vickers from the Comptroller's office.
Hello.
Hi, Susanna. We're live, so I'll introduce you in a second. Back to Tom.
Okay, all right. And so what we've been doing on the divestment front is simply looking at the way a pension fund performs, and we've counseled very tiny ones, very big ones, and I was involved with the state fund for a long time and the city fund for a number of years. And the focus that I want to just have to do this quickly, and it is not simple. So anyway, Exxon for many years, decades, was the leading performer of all stocks in the world, and they have for the last 5 years. And we just put this up against the Standard & Poor's 500, and Exxon is the dark blue line at the bottom, and Standard & Poor's, which is basically a proxy for the economy. And we're seeing that Exxon for the last 5 years has performed poorly. They are a laggard, and that is news, big news to any fund. There used to be 7 companies in the Standard & Poor's top 10 that were oil and gas. There's currently 1, it's Exxon, and it just fell to 8th in that setting. Anyway, could you go to the next one? Next slide. Oh, thanks. So this is a little more complicated one, but it's easy to follow. This is 2017 after a full 16 months of oil price increases, and you see that the energy sector is at the bottom, fighting with telecommunications for last place in last year's stock market, and at the top, which is where oil and gas used to be, is information technology. The markets have shifted dramatically. This is true for 3, 5, 7 years, and we see it going forward. We're not the only ones, and I'll just do a quick little thing on Norway. Norway is a very large fund, $1 trillion. They've made their money in oil and gas over the last couple decades. They're probably, arguably, some of the wisest people on this stock market and the trading and buying and selling of oil and gas in the world. You probably find some better, but maybe none better, but maybe some of the same. They've made a decision. After looking at their portfolio, they have a proposal, and their proposal is to remove oil and gas stocks from their index, because as you can see from this particular one, an index that included oil and gas for the last 5 years would pull the index down. And they are seeing that their future is in looking at their oil and gas interests as being highly speculative and no longer a quality stock of the grade necessary to keep in an index. But they're going to keep trading, and I think they're going to trade and shrink over time, looking to do more of an active management portfolio, but looking to shrink things. So that's a way that one fund has chosen to sort of deal with its carbon exposure. Others have just gotten out. told their money managers, we want a fossil-free portfolio. You show us how to do it. We may not do it right away. We may not do all of it, but we need to ask the question, because this is a sector that was performing gangbusters for decades and now is weak and declining with a negative outlook. And so the question for the fiduciary is, and I know Lisa's going to pick this up in a minute, is the fiduciary has an obligation to ask questions when these kinds of changes are taking place. And in this instance, our view is they have an obligation to tell their money managers they want to see what a fossil-free portfolio will look like for the city in this instance, and how do we go about getting there. 4 or 5 years ago, I might tell you that I would be very worried about this. Now I would think there are manageable risks here. There are products on the market that can be tailored to any given fund that can help get there. But the first thing is you have to ask the question, and you have to tell the managers what their job is, which is to structure a fossil-free portfolio and show you how to make your targets, which according to my chart here isn't so hard. It's not that hard to not be in last place.
That's great, Tom. Thank you for doing that. I'd like to pick up that point with Lisa Ann Hamilton, the director of the Climate and Energy Program at the Center for International Law, at the Center for International Environmental Law, on these points around fiduciary duty. Lisa?
Great, thanks so much, Dan, and thank you, Tom. So just very quickly, as Tom mentioned, the whole process of divestment and meeting fiduciary duty is a rather complex and layered set of issues, but we're going to do our best to make it as concise and compelling as possible. My goal here is just to provide an overview and a snapshot about what constitutes prudent exercise of fiduciary duty. Give you a brief overview of the legal considerations about prudent exercise of fiduciary duty, and to understand divestment as both a process as well as an outcome in the exercise of fiduciary duty. This first slide here highlights two balancing considerations, particularly with climate change. Climate change is deemed as both a non-economic or collateral issue, often labeled under environmental, social, and governance issues. And these issues are considered those issues that are outside of the issues of financial returns. And so if you see the top provision there, this emphasis on the rate of return, the liquidity and current returns of a portfolio, as well as projected returns, those are considered those primary economic drivers in your exercise of fiduciary duty of acting in the best interest of beneficiaries and participants. Oftentimes, as Dan Hinton talked about, the moral issues behind climate change, those issues are typically thought of as collateral, that those are societal considerations that exist apart from the prudent exercise of fiduciary duty from a financial perspective. As Tom just highlighted, though, and this is a source of confusion or a source of resistance about responding to climate change, is the fact that climate change is in fact a material financial risk. As Tom highlighted with the declining performance of what had once been gangbuster and reliably profitable fossil fuel assets, you have the Paris Agreement, which became what some consider the mother of all market signals, that all of a sudden shifted this once solitary or typically perceived as a collateral issue to a material financial issue. Next slide. Next slide, please. So the things I want to highlight here is about fiduciary duty as a process. Exercising a fiduciary duty means you consider a whole basket of considerations. The legal authorities that we look to often as guidance come from ERISA and the Department of Labor, and although they are not binding on public pension funds, they do provide a good set of guidelines about how a fiduciary duty can best exercise those duties. Next slide, please. Particularly when we talk about the former way of considering ESG, climate change fit very neatly under the E of this environmental consideration. And it was well understood that fiduciaries can't expect lower returns or greater risk, but may take ESG issues into account as tiebreakers when competing investments otherwise serve similar economic interests. And the idea was that, for example, you have high rate of return on a particular set of assets, and then you would be acting prudently if you considered climate change as it would serve the health benefits of your community. It would serve those best interests. And that is still permitted exercise and legal exercise of your fiduciary duty. Next slide, please. But what is becoming increasingly apparent, again, is this idea that if you have fossil fuel assets that are now have a number of regulatory headwinds, not only in terms of globally, changes are being made in terms of emissions, changes are being made that are directing the market. For example, the rise of electric vehicles have put tremendous pressures on demand for fossil fuels. All of these factors are going to have a material financial risk on holdings where there is significant exposure to carbon-intensive assets, carbon-intensive industries, and certain sectors of the economy, particularly coal, oil, and gas. So the question then remains, often what we hear is diversification as being a defense against divestment. And what needs to be highlighted here is that diversification is intended to minimize the risk of large losses. Also, this is a provision under ERISA, so that it requires a thorough and robust assessment. And again, as Tom mentioned, you're directing your asset managers to conduct this kind of risk and assessment to determine exactly what your exposure is, particularly if certain investment decisions were made prior to this Paris Agreement, prior to this December 2015 benchmark. Chances are that there are now a set of different material financial risks that now influence the portfolio. Prudent exercise of your fiduciary duty means that that assessment is conducted, as well as that in monitoring that plan investment, that you remove imprudent ones. And again, there is no law that says divestment must be an outcome of a particular assessment. But what divestment does do is reduce the risk of exposure, which is consistent with fiduciary duty. Next slide. So again, I just want to highlight these issues of, I know a number of, in the course of CL's work, we released the $1 trillion transformation in 2016 and have been part of a process of outreach and engagement to discuss climate change and really begin to develop this more robust thinking about climate risk. And the two big takeaways are prudent exercise of fiduciary duty is about a process, a well-documented process. And I believe Susanna is going to speak to that process in a minute. And so if at the very least, a prudent exercise of fiduciary duty means that you are monitoring the investments, that in order to act in the best interests of beneficiaries, these factors should be taken into consideration, not just for their material financial risk, but also for these moral risk, as New York City is doing. So with that, thank you again, and happy to answer any questions.
Great, thank you so much, Lisa. And let me turn it over to our partner in municipal government, Susanna Vickers, the Executive Director for Pensions at the Office of New York City Comptroller Scott Stringer. Before I do that, I just want to let people know and remind people about the opportunity to ask questions. And there's a question box on the side of the screen that you can type in. When we get to the Q&A period, we'll be able to unmute you and ask a question. But feel free to start typing in any questions you have now, and we can start doing that work to identify the folks that we're going to unmute and have that dialogue. So with that, Susanna.
Hi, thank you very much. And I apologize in advance if something goes wrong with technology. I'm talking to you guys only on the phone. I don't have the session up on my computer because for some reason the controller's office seems to block the mayor's office. I don't know what it is. But I'll just get started in terms of the process. For the past 2 years, trustees of the retirement systems have been looking at the effect of climate risk on our portfolios. Based on that work, we realized we needed to do a deeper dive on the issue of divestment in order to make informed decisions. And so, what I wanted to mention is that divestment and the exercise that we're engaged in now is something that is sort of in the middle of our process. 2 years ago when we started, we launched a carbon footprint analysis. We hired an outside entity to measure the carbon intensity and the carbon impact of our portfolio. And then we had a different consultant sort of come to us with the climate risk assessment report. And that led us to the decision that we could continue to ask questions around divestment. For us, engagement has been going hand in hand with divestment. We're working hard through the work of our corporate governance office to engage fossil fuel companies and push for climate competent boards to help companies successfully navigate the transition to a low carbon economy and address the risk of climate change. Again, as owners, as stockholders, as investors, an additional way to look and address these risks is to make sure that the companies are addressing the risks through their board policy, through their personnel, through their reporting. We want transparency around climate exposure and climate risk. And we've also, the funds have also joined the Climate Action 100 initiative, and that initiative targets the companies responsible for 85% of total greenhouse gas emissions. And, we look at that effort in two different ways. Interestingly, some of the people on that list are not oil and gas companies. They're companies that use a lot of electricity and are responsible for emissions. And by engaging those highest emitting companies, we may have the effect of, further reducing the success and the performance of oil and gas companies. So that's sort of an interesting component to how we're looking at divestment. Engagement has its limits with respect to fossil fuel reserve owners, coal and gas and energy and utilities. We're not going to turn those into solar companies. We're looking at divestment as an important additional tool. I guess this is the next slide, please. Okay. And what that plan really is our goal of formally divesting the city's pension funds from fossil fuel reserve owners in 5 years. And we're planning to do that while maintaining our fiduciary responsibilities. The first step in this process, we think, is among the most significant divestment efforts anywhere in the world. Climate change poses a real threat to many of the assets in our portfolio. We must address this risk in a thoughtful and deliberate way. We believe if New York City can crack the code, other long-term investors may join us. So the chart that's on right now, I believe, is just laying out our strategic and prudent process. So where we are now is in the beginning of the RFI process. Last month, we issued a request for information. The RFI has been broadcast out and downloaded by people across this spectrum. And the purpose of the RFI is to seek a broad and diverse array of perspectives on how to structure an RFP for investment analysis services. And responses to the RFI are welcome from a variety of disciplines, industries, and fields, including investment, finance, business, legal, scientific, and environmental policy communities. Responses are welcome from persons and organizations that do not intend to propose services in response to the RFP, but who wish to provide insights and knowledge that may assist with the objectives of this RFI. So what we're hoping for by the beginning of June are many thoughtful responses from across the spectrum on topics like scientific, environmental, and investment ideas, as well as weighing in on legal and fiduciary duty. And the city, the Comptroller's office, along with the Mayor's office, will be spending the summer reviewing the responses to the RFI. And we hope very much that we'll gain new insights that will help us develop the RFP. The RFP is for investment analysis services, and I think I heard Tom say earlier that what can be done as a next step is asking investment managers to present and think about how to put together a carbon-free portfolio. So after the RFI, we'll have an RFP for those kinds of services. We'll work to develop and implement a plan for divestment. And we don't know what it's going to exactly look like now, but we're working very hard to complete our divestment by 2022. Thank you.
Great, thank you, Susanna. And the last speaker that I'd like to turn it over to, Henry Garrido, the Executive Director of the American Federation of State, County, and Municipal Employees, District 37 here in New York. Henry, for the perspective on labor.
Yes, good afternoon, and thank you for the opportunity to provide our perspective from labor. Now, I think that divestment from fossil fuels, from our perspective, is first a very prudent approach to long-term investments. I mean, we represent a lot of the not only actives and retirees who are looking at this from the perspective not just on short-term but long-term investments and what it means to the plan. NYSERS is going to be almost 100 years old, so we're looking at a long-term investment. So we believe for labor, if the question is why is labor supporting divestment, why is DC 37 supporting divestment, I would say first is because it's the right thing to do for the investments, not just on a short-term but specifically on a long-term view of the investment work. And I think it's added that we are not only looking at this from a prudent investment perspective, but it's also the right thing to do. And I think labor has always been in the forefront of a lot of progressive ideas, but this, I don't think I've ever come across one that makes so much sense for labor from all perspectives. From the investment side, we've seen the analysis and the return that Susanna was referring to. From the perspective of being the right thing to do for the planet, we're all standing here and breathing the air and everything else. But also, if you look at it from the perspective of good paying jobs that the renewable energy based companies have created, I think it's a win-win-win situation for us to continue to pursue this. I would say that one of the concerns we have in labor is labor organizations like mine have always been perceived as these old dinosaur-like, look at making changes for change's sake, because they have fought so hard historically to try to maintain or improve the conditions of working people that sometimes they get to be a little close-minded, if you will. I think that I have seen a complete turnaround within the labor movement, whether it's the building trades conversation about divestment, or also public and private sector combination of the discourse on this. And we think it's from the perspective of labor, things are changing, and we are glad in DC 37 to have been a part of the the movement to lead to divest. I think that if you look at the change in the economy, and you look at since the Great Depression, where the changes have been and on the labor market, I think this is going to be one of the major labor market, changes since the Industrial Revolution, and we need to be at the forefront of it in labor because it produces better returns and better climate and better air and good paying jobs for many people. We think that we are on the right side of history of this. I will say, though, from the perspective of labor, part of the problems we get is that a lot of the progressive organizations that constantly work with us to try to promote good progressive ideas, they tend to suffer a little bit from, I would say, impatience. And I don't mean that in any disrespect. We want to get this done now, and they don't understand why sometimes things are done a certain way. And I applaud both the mayor's office and the controller's office not to react politically to just do this, but do it right. And in doing so, I think that one of the worst things that we can do is to rush to divest in a way that is not prudent, and in doing so, create a problem or a failure that could be used as an example of why we shouldn't do this. And so I am all for doing this in a prudent manner. And so Susanna outlined some of the pieces that we have been privy to as trustees of the NYSERS pension board. But I think that for our folks, we need to make sure that this is done right. New York City is leading the way in this conversation. We need to make sure that it's done the right way. And finally, I would say, look, it is estimated that more than 100,000 city workers will be retiring within 5 years. That is 1/3 of the city's entire workforce. That is a major shift on a new population coming in. And what we're seeing in the labor markets, especially in the public sector, is a tremendous change in the demographics of the city's workforce, age, gender, all kinds of backgrounds. And what we have found in our labor in talking to our members is that the younger workers that are coming on board, less than 35 years old, overwhelmingly support this as a social policy, in addition to a policy that protects their pension and their investment. So if we in labor are going to be about listening to our members, we should also take account to the fact that this is something that they're looking for, and they're looking for the unions, as always, to take a lead on the progressive issues, because unions are not just about working conditions and contracts, but also about good public policy, which help us all. Thank you.
Henry, thanks so much. On the next slide, there's go back one. So on the last slide, there is a website that we've set up with some more resources on some of these topics. It's at divestinvest.org/governments. And it's just a set of resources and reading on fiduciary duty and the outlook on fossil fuels and what divestment means that we think is a helpful set of tools and just reading materials to go a little deeper on this. Again, we've set this up to be helpful. And so I see that we have a few questions in our question box. I want to encourage everyone before we go to the first one to, if you have any questions you'd like us to answer for any of the speakers here today, just type that in the chat box, and then we'll go ahead and we can unmute you. And I'll just give you a 10-second heads up. But we've got a question from Kumar. I think we'll go to you first, and then a question from David that we'll do second. Again, if you have any questions, type them in the box. And if anything comes up after this, the contact information that came on the invitation for this, we'd be happy to field any questions after the webinar as well. But with that, hopefully we can unmute Kumar to ask a question.
This is Kumar Jensen. I'm the Sustainability Coordinator for the City of Evanston, Illinois. And we've been having some community conversations related to fossil fuel divestment. And one of the questions that we've sort of had is related to strategy in terms of how to start those conversations internally, and understanding, in conversations with the CFO or, pension managers in our pension board, sort of what strategies there are to begin the conversation, because this has not been a conversation had sort of internally with city staff yet. And so any suggestions on how to frame the conversation and bring in useful information to begin that process would be much appreciated.
Great, thank you for that, Kumar. I think maybe I'll start off, and I wonder if some of the other panelists, and particularly Susanna, might have other answers to that question. But you know, in some ways, this question of divestment starts in two ways. One, in our case, it takes leadership to make something like this happen. But what allowed that leadership to push this solution forward was the analysis that had been done around the carbon intensity of the portfolios, the deeper understanding of what the different options were that were out there. And so, like many things, there's a data-driven element to this that I think is helpful to appeal to you know, pension experts and the financial folks that need to be part of this solution. So I think it, again, it sort of wraps up, you need the leadership to push it forward, but it needs to be data-driven and based on the realities of the investment. Susanna, do you want to add anything to that?
Yeah, thanks, Dan. I would definitely agree with you that the mayor's leadership and the controller's leadership on this, you know, was absolutely vital to sort of getting people to focus on it and come along, because it's not easy. But, you know, I would also say that every pension system has its own governance structure and its own way of making decisions. So in our case, you know, the investment decisions are made by the trustees and carried out by the investment advisors and managers. So we really needed to get a group of trustees interested in pursuing this, spending the money to hire the consultants, to do the analysis, to do the carbon footprint. And, you know, we were able to assemble a critical mass of people who wanted to begin asking these questions.
Great, thanks. And I think maybe just adding one more point to this, something that we've seen after our announcement is the goodwill that also then flows for folks that are willing to take bold action like this. And so, you know, to some degree, going to your bosses or the folks that make the decisions on this in your own cities, there's a lot of goodwill that flows from this and good press that comes from this. That's not the only driving decision, but it certainly is a nice outcome that comes from it. I think we have a few lined up. So I'm going to go to David first and then Stuart after that. David?
Great, thanks very much, Dan, and thanks for this webinar. It was actually exceptionally helpful, and I thought I understood the ins and outs of this issue pretty well. So one of the questions for me, I had two, but the second one I think got asked by Kumar. From what I just heard, it sounds to me like it is absolutely legally completely appropriate for pension trustees or for a mayor to take the moral and ethical position that we shouldn't be investing in fossil fuels and start from that proposition, provided that you go through all these steps and do a proper, objective, and fair analysis as set out in some of the slides. And my question is, do I have that right? Because that will be a question that I'm with the C40 for those who don't know me, that our cities and mayors are going to ask. Can we start with this proposition, provided that we go through all the steps? And obviously, if the steps tell you you can't do it from a fiduciary duty perspective, I guess you stop. But that's my key question, because if that's the case, I think it makes the path easier for a lot of people, and that was actually a little bit news to me.
Dan, can I jump in on this one?
Absolutely.
I would say that, you know, it's best to start with a fiduciarily, you know, sort of couched language, talking about, you know, that very topic. So what we did when we announced our bold proposal was, you know, talk about the risks that climate change and that some of these companies pose. If you start with a purely moral standpoint that you're kind of trying to prove, I think that that some may get pushback, either from people in their own cities or from other stakeholders who you know are hostile to this, and this just sort of feeds into their perception that divestment is not being done for financial reasons.
Yeah, I just want to add to that. I think that's right, Susanna. I mean, I understand your point where you're coming from in terms of what is an easier lift. It's that when, and this is just in terms of the work CL has done to support communities who share the same interests, who believe that it's morally reprehensible to profit from the suffering of others, and that given where we've seen the direction of climate change and fossil fuels contributions to it, there has no place in pensions. However, the biggest pushback, as Susanna just mentioned, is that, and especially because the guidance that just came out of the Department of Labor, which was very negative in tone about ESG as a defining factor. And the reality is that that guidance, as negative as it is, you can still make decisions based on ESG, but you're going to get pushback, and it's going to be pushback saying that you're not acting in the best interest of your beneficiaries, that this is a political speech issue. I think that's been a commonly used reason to push back, saying that this is being done for reasons that do not benefit the future of the fund. And I think that when starting off with a both and approach of saying, look, we not only understand this as a moral issue, but we understand it as a material financial risk, that there are uncertainties out there. We don't know what the exposure is. We don't know, is this going to affect the fund in a way that it needs to be monitored. We encourage the process for divestment, particularly for those who may not be amenable to starting with that kind of an outcome, just encouraging the monitoring, because I think at the end of the day, there's far more risk exposure than I think people are currently aware of, which is why that process is so important. So again, I would encourage a both and, but yes, it is legal to, so long as the rate and returns are comparable, the risks are comparable, that ESG can be a tie-breaking factor for decision-making on investments.
This is Tom Sanzillo. Was in the public office for a number of years, and the first thing, and I'm going to say something that may not sound like what a financial person is supposed to say, but it is very important. When you're in a leadership position, you don't know what you signed up for, right? So who signed up to make climate policy on a pension fund? Absolutely no one. And yet they are there and having to make the judgments, and that's where the social and cultural trajectories have left us. Now, on the finance side of this, and so the moral argument is very important because it's part of the calculation. But I look at these things from a cumulative financial risk analysis, and Lisa touched on some of the points. There are serious moral arguments to be raised here. There are also competitive arguments that the industry is facing right now and not doing very well with. So there's competition and less profits, which is supposed to be something that we're all concerned with. The industry will be smaller over time. You have, in another way that the moral question is raised, is you have fairly substantial permanent public opposition at almost every level to fossil fuel development, and that is a material risk. Ask any CEO who has to just put up a few $100 million and now has to cancel the projects because of various kinds of legal attacks and community attacks. And that this is a cumulative risk thing. And as you get more involved in it, you're going to see that these investments aren't worth it anymore. And they used to be. And I was a very serious player with the pension funds in the fossil fuel sector for many years. But it is not the same market, and it's not the same calculation, and the calculation is far more complicated and not worth it.
I hope everyone has found this to be helpful. I want to thank everyone for joining us this afternoon on this lovely Friday afternoon, first real set of spring days we've had here in New York City. I hope you're able to enjoy it. And on behalf of the sponsors of this event, C40, the Mayor's Innovation Project, New York officials elected officials to protect New York, and ICLEI. I'd like to thank everyone for joining us, and on behalf of the mayor and the controller of the city of New York, thank you. Have a great afternoon, and we are available to follow up. I think we'll be posting this webinar, and we'll be able to share these slides after the event concludes. So thank you very much. Have a great afternoon. Thank you.
Thank you.
Thanks, Dan.